Alright guys, pop quiz. Out of all the videos that I have made so far, which one of them has the highest impact on your trading account? None of them. It's this one, the one you're watching. And here it is. It's the risk video. You knew it was coming. And I'm very glad it's here. This is essential viewing because in this video, we will talk about the dangers of bad risk. Many of you have gone through what I'm about to show you. It's going to sting a bit, but even if you're just trading for the first time, hopefully you're going to learn what having subpar risk can do to your account, and you will want to make sure that you never make these mistakes yourselves. We're going to go over that magic number. What percent of your trading account should you be putting on every trade? We will answer that here. We're going to use the ATR. Do you guys remember the ATR video? It is the most successful video I've ever done in terms of views. People loved it, and it's a good thing they did because we are going to carry that forward into every video I think I'm ever going to make in terms of money management. We're going to use that today to figure out just how much pip value you should put on every single trade you make from here on out. And we're going to talk about how many trades you can have open during this whole time. We're going to touch on that a little bit. And then after everything we have talked about, there are still a couple ways that you can really, really screw this up. So stick around till the end. You're going to want to know because you're going to watch the whole video for nothing if you don't know that part. So I think you know the answer to this, but do you know who pays almost no attention to risk, has no numbers in place, has no plan in place, and just spends all their time worrying about trade entries? It's the 99%. Yeah, it's the exact type of people that we strive not to be. It's the exact group I am trying to get you out of. That 99% of Forex traders that either lose money, break even, or just make enough to barely keep it going, but not enough to trade at a pro level or to save for their retirement or any of the places that all of you I know want to be because you all told me this. Not one of you took the time to learn Forex, risk your own money just to be in this 99%. We're going to get you out of that, but we have to understand who these people are and what they do so we don't become them. Let's talk about that. The 99% has no set risk. And if for some reason they do, it's some random arbitrary number they pulled out of thin air. And that number changes depending on how they feel, depending on if the last trade was a win, if the last trade was a loss, if news is coming up. They have no set plan in place. And after they end up losing their money, which they're going to do, they chase their wins. That risk goes way up so they can get that money back. Really dangerous slope to go down. And they also have no understanding of what we're going to talk about at the end of this video, a big trap that people fall into. Now let me show you what happens when your risk is out of whack and it's going to ruin your account. It's just a matter of when, and let me show you how that affects everything you're doing and everything you're going to do in the future. So if you have a $50,000 trading account, it's just the arbitrary number I always use, and that account goes down 20%. It goes down to 40,000. You might say to yourself, well, that sucks, but I can make it back. Problem is, it's really hard to make back. You have to beat Warren Buffett's average annual return just to get yourself back to break even. That sucks. And at the rate you're going, this has no chance of happening. You would have to all of a sudden turn into an amazing trader overnight just to get back to where you started. Not good. This is not why you started trading, because this here alone is a hole that is pretty much impossible to get out of. Let's say you took it down to half the value. Let's say you brought it all the way down to 25,000. You're like, well, that's still 25,000. I can do something with that, right? Not really. You'd have to double that just to get back to your initial deposit. There's some very, very good traders out there that would take them 3-4 years, even after compounding, to get 100% return on their money. It's certainly not going to happen to you. If this is you, you might as well just pull that 25,000 out, hit the reset button, learn how to trade all over again, and then maybe start over if you think you figured it out. But at this point, you might just have to take a step back and think that maybe trading just isn't for you. Maybe you're better off just giving your money to somebody else. Because getting down to this level is trading suicide. Do not let this happen. Now, getting into these holes is the result of trading recklessly, but there is also a danger of trading too timidly. Fortune favors the bold. Nothing favors the timid at all. And this is a bad way to go too, because even if you're a very good trader, if your risk is too small, it just makes your trading not worth it. Let's say you took that 50K up to 52 over the course of a year. That's 4%. That's good, but there are places where you can just park your money and do nothing and make 4%. If you just had a reasonable risk profile in place, that number could be much higher, and that number could be really worth trading. You compound a better number over and over, and that's why people trade. That will get you out of the 99%. But if you're trading a lot and at a very successful level and only pulling this number out because your risk is too low, you might as well just demo trade. Learn an actual risk profile. See what that does. If you're good, your account's going to look really nice at the end of the year, and you can carry that system, the entries, the trade management, the money management, the psychology, everything you're doing right, carry that over into a real account and start making real money. Now look, 4% is not bad. It's way better than most traders do. But if that number is low because your risk is too low, you're doing it wrong. The people in the slide before that took their accounts way down were too reckless. The people in this slide here were too timid. Here's what you have to understand about risk for all of you people who are too risk averse. The most successful people in the world, all of them, they take lots of risks. Every day, all the time. The big difference is they know how to minimize that risk better than everyone else. When you think of the word risk, just don't think of being reckless or jumping off a cliff. That's not how you need to look at it. I take risks every single day I trade, but I make sure that even if I take a loss, the chances of it being a big loss are very, very low. We're going to talk about that in this video. That's going to be really great. I take risks every time I make a video or make a podcast. I'm putting myself out there. I'm opening myself up to criticism. I'm opening myself to people that might watch my video for 20 seconds and lose interest. But I minimize that by doing my best to, 1, find a big problem that people want to solve, 2, share knowledge that can help that problem, and 3, find out what people want to know about first and then make a video based on that. I am constantly trying to be in that headspace of somebody who is not afraid to take a lot of risks, but also every time I do, calculate the odds and do whatever I can to minimize the chance of failure. This guy doesn't take any risks. He will never be successful. He's always going to be unhappy. He's always going to wonder what might have been. This guy takes a billion risks. He makes billions of dollars. And I guarantee you it's not because he was reckless with that risk-taking. Every risk Richard Branson takes is very calculated. And really, this is the only mindset shift that many of you need to make. Start taking more risks, but just understand that you're going to be okay if you take the steps to minimize what that risk actually is. So hopefully you guys understand that, because you cannot be a good Forex trader without this. It's something I need to touch on before we go forward. But I've touched on it, so let's go forward. Now we're going to talk about that magic number. What percentage of your trading account should you be risking on every single trade you make? Now, you guys that have been with my videos for some time, or those of you who listen to the podcast, already know how I feel about conventional wisdom. Conventional wisdom is what gets people into the 99% and what keeps them there forever. Conventional wisdom in Forex is almost always the place you do not want to be. You want to seek out better and seek out more. In this case, conventional wisdom got it right. Almost everywhere you see, they're going to tell you the same thing. Risk 2% of your entire trading account on every trade. And they're right. They're exactly right. I feel the same way. 2% is the correct number here. But it's not always that simple. There's some rules to follow behind this. Understand, 2% is the most you can lose on a trade. Make sure your stop loss indicates this. All right? I'm going to show you later on in this video how to calculate this. And the best news is when you actually lose a trade, more often than not, you're not actually going to lose 2%. You just set your stop loss there. A lot of times you're going to exit a trade well before price even hits it. If you have $50,000 in your trading account, 2% is $1,000. That seems like a lot of money to risk on one trade. And I suppose it is, but you have to look at it from a percentage point. You don't want to end up like the timid guy who does really well and only pulls in a 4% return year after year. You have to take risks like this. But just understand that far more often than not, when you lose on a $50,000 trading account, you are not going to lose a full $1,000. Again, it's about taking those risks, but also doing everything you can to minimize those risks. So here is the point in the video, and this is the point in any video I have ever done, where you are absolutely going to want to take notes if you don't take notes already. You are going to want to have these little simple equations next to you somewhere so you can always go back and refer to it and plug it in. Because if not, you're going to have to go back and watch the video, and that's a pain in the ass, and it's better just to have it right next to you. So pause the video, get your notes out, and here we go. So you remember me saying this before, and I meant it. We're going to use the ATR a lot here. You guys have probably seen the video. Like I said before, it is my most popular video to date. I think it's because people love indicators, and I announced in that video and in the title that this is the top one that I've ever used, so people got pretty excited over that. But its utility is for money management, and this is the money management section. Ooh, if you didn't see that video, let me just go over what it is really quick. The ATR indicator, all it does is just tells you how many pips from the top of the candle to the bottom of the candle a currency pair moves on average. The default settings is 14, which means it takes the previous 14 candles, takes the distance between the top and the bottom of those candles, and makes an average out of it. And so this can tell you, it's never going to predict the future, but it can best tell you what to expect going forward, how much a currency pair is moving right now and how much it is expected to move in the future. If this is unclear to you, just go back and watch the ATR video. If you haven't, like I said, it's essential viewing. You're going to have to watch it anyway. But the magic number for the ATR, all right, guys, here's where you're going to want to write this down. 1.5 times the ATR for a currency pair is where your stop loss should be. 1.5 the ATR away from where the price is right now. So for example, if the ATR for a particular currency pair is 80, your stop loss is going to want to be 120 pips away. Simple as that. Now you always know where to put your stop loss at any given time once you enter a trade. Now this will change if you start making profit. But for now, when you very first enter a trade, this is how you determine where your stop loss goes. Your stop loss does not go by some support or resistance line or on some Fibonacci level. No, just do it this way and you'll always know where to put it. Ignore everything else. Now, also for your notes, we are going to go to my charts, and I'm going to actually do this in front of you so you can see it. But we now need to find out what our pip value is going to be for any given pair. It's not going to be the same across the board. That's ridiculous. We've been through this before. What you need to do is find out whatever 2% of your entire account is. All right, so we said before, if it's $50,000, 2% is $1,000. But your account's going to go up and down, so this number is going to change a lot. So you need to figure out what this is first. And once you do, we call this your risk. Okay, you got that part? We move on. Then you got to figure out what 1.5 ATR of the currency pair actually is. You may have already done this, but this is where you're going to put your stop loss. And now at this point, you know where your stop loss goes. You know how much of your account you're actually risking. So all that is left to do is take that risk and divide it by the ATR. And that is going to tell you how many dollars per pip you need to put on this trade. And then once you do this equation over again, it's going to show you the pip value for every single trade you make from here on out. Make sure you have written this down. I'm going to go to my charts and my trading account and show you how this works and walk you through it. But you are going to want to have this written down somewhere. So go ahead and get all that down. And once you do, we're going to go ahead and go to my charts. So here we are at a practice account I set up through Owanda, just so I could show you guys what to do here. Now, I literally set this up yesterday, and I went ahead and entered a legit trade, so my number is not at an exact 50,000. So what I need to do is take where my account is right now. Yes, even if I have a trade open, this is the number I want right here. And it's moving, so I'll just go ahead and kind of freeze it right here, 52.36. I don't worry about the cents. but we're going to use that number to figure out our risk, 5236. So pull your calculator up. I'm doing this with a mouse, so be patient. 50,236, and we will multiply that by 0.02, and that's how you get 2% of your account. So I'm just going to round that number up to $1,005, and I am going to write that number down. That is my risk. So now I have to go to whatever currency pair I want to trade, find the ATR, multiply that by 1.5, and at that point I will have almost every number I need. Let's go do that. So as usual, I don't cherry pick. We just go straight to the euro dollar, the most commonly traded currency pair in the world. Go to the daily chart because that's what I use. And I already pulled the ATR up. So the ATR is currently sitting at, let's just say 86. So that's good. Now I know what to do. Pull my calculator up, cancel that, and I will take that 86, multiply it by 1.5, and there you have it, 129. Now I have the numbers I need, and it's nice my calculator did this, just put them off to the side, to figure out what my pip value is going to be. Now, my broker does this for me. You're going to see this really soon here. But you might want to go ahead and figure out what your stop loss is going to be now and write that down. So let's just look. Do we want to go long or short here? I don't have a dog in this fight. I'm not in this trade. I really don't care which way I go. This is all demo. So well, we are trend traders here. Let's just go ahead and go long. Now, I don't think you can see it, but the price is at 1.1707 as we speak. And we'll show it here. So no matter where it goes, after I'm done talking, let's just go ahead and take that number, 11707. You don't really need the decimal. It's pretty easy to figure out. And then we're going long, so this is going to be minus. If it was short, we would do plus. But minus a 129 pip stop loss. And now we know to enter our stop loss in at 1.157. So then I would write that number down too, so I can plug that in. All right, so we know where our stop loss is going to be. We have these numbers. Now we just go ahead, we go ahead and figure out what our pip value is. So take that number there, because we round up, and then divide it by 129. Your pip value is about $7.80. Perfect. So you can write that one down too. You won't have to write a lot of these down going forward because you're going to be used to it, but in the beginning, it doesn't hurt to write stuff down. So let's go ahead and make a trade knowing what we know. All right, so back here on our FX trade, go ahead and pull this up because it's got all our numbers right there, which is nice. We'll go ahead and make a trade. Oh, we got rid of our calculator when we did that. Maybe we can do both here. Let's see. Can both of you coexist? Yes. Okay, so as far as units go, you're going to have to kind of guesstimate this because we know we want this right here to say $7.80. We just don't always know how it's going to get there. Now, the good thing with the Euro USD, it's generally pretty easy. I think we can just go 780,000. Oop, not that much. 7,800 is what I meant to say. And now we have exactly what we need. All right. So now we got to put our stop loss in. And if I just go like this, if you guys have a Wanda, you can just do this and put in 129. And it'll do it all for you. But some of you don't have that option. So let's just go ahead and do it the old way. And we know that we want 1.157. All right, so we have everything in order. Our stop loss is in place. Our pip value is where it needs to be. We have the right amount of risk on the table, and we enter the trade. And there it is. This is how you enter a trade with the correct amount of risk. And that is how you figure it out. Now, since I'm not really in this trade, let's just go ahead and cancel it. Close, yep. Take our $10 loss and we move on. So that's how you do it. And I just looked at what I did, and I should have gone another digit over on the stop loss. So for you guys paying very close attention, that's the one little mistake I made. I went 4 digits instead of 5. But we need to move on here. I hope this makes sense to you. I just want to give you the gist of how this works. Now let's move on to the really good news, because losing $1,000, even on a $50,000 account, does not sound very enviable. But the good news is, I rarely have my stop loss hit. It doesn't happen very often. If I'm putting forth $50,000 in a trading account, I'm barely ever losing $1,000, because I have an indicator that gets me out of bad trades before this happens. And you can find one too. I'm not going to hand feed this one to you. This one you're going to have to find. But they are out there, and I call them exit indicators. All right, so let's go to the outline of the algorithm that I have and show you what you need. I have already given you the only thing I'm ever going to actually physically give you, and that's the ATR indicator. If you guys follow the podcast, on episode 9, I talked about finding that confirmation indicator. Find an indicator that says, yes, we are officially in a trend. You may go long or you may go short. And a lot of you have already gotten to work on that, and I'm really happy to see that. But you are also going to need at some point an indicator that not necessarily says, okay, you can go long or short, but an indicator that says, yeah, this trend you're following, that you're on right now, it's probably done. And when you find an indicator like that, it is going to get you out of a trade well before your stop loss is actually hit. When looking for an exit indicator, you want to find one that lets the trade breathe, that doesn't get you out of a trade so soon that the trade doesn't have time to actually do what it's going to do, but also an indicator that gets you out before your stop loss gets hit. That's what you are going to want. Now, sometimes a really good confirmation indicator can do that, but sometimes you're going to find another indicator that just works better for that purpose. So as you guys are all out there demo trading right now, trying to put that great algorithm together, start also looking for a great indicator that gets you out of trades before price hits your stop loss. This is how you take risks and minimize those risks all at the same time. If you go to the blog for episode 9 of the podcast, I will link the blog below. It tells you where the best place to go, or I guess best is subjective, certainly the largest place to go when it comes to finding those under the radar indicators. So if you are stuck for a place to go to find these and test them out, hit that link below and it will tell you. And yes, I am leaking all of this out piece by piece. We go slow here, and we do this for a reason. I already feel like I'm giving you a lot, telling you to go out and find a confirmation indicator and an exit indicator before I even start giving you these other pieces. But if you can start finding good ones, you're going to get closer and closer to having an algorithm that really works. And if you couple that with really great money management, the sky is the limit. You will be doing things the 99% never even thought of doing. And getting you to that point is the whole reason this channel was even created in the first place. It's the whole reason the podcast was created. The podcast sets you up to succeed. The YouTube channel actually shows you what to do and what not to do. So you have this in place. Start getting that in place and that in place, and you're going to be in a really, really good spot. And we're going to continue to go slow and ever so slightly move closer and closer to where you're going to want to be with this. But there is a warning. I mentioned this early on in the video. You can really stumble over this if you're not careful. Let's talk about it. So there's a way to over leverage here. And you're about to see what I mean by that. But I didn't create a slide on this presentation that talked about how many trades you can have open at one time. Really, you can have as many open as you want, all at 2% risk. That's fine, as long as you avoid this pratfall right here. Do not trade the same currency more than once at a 2% risk. Write this down if you have to. If you've been taking notes, add this to your notes. This is big. So what do I mean by this? For example, let's say you really think the dollar is going to get stronger, and you are getting signals left and right on your charts saying that you need to put your money behind the dollar. Don't do this. Don't take a euro dollar short, an Aussie dollar short, and a dollar yen long, all at a 2% risk. Don't do that, because if you do that, guess what? Your 2% risk is gone. You now have 6% of your trading account on the United States dollar. If anything were to go sideways with the dollar, or if the big banks just woke up and said, no, well, it's time to take the dollar short, you're in trouble. You might have 3 trades that all hit at stop loss, and in one fell swoop, you could have put an almost irreversible dent into your trading account. You guys know how long it takes to make up losses like that. Do not let this happen to you. All right? Now, there is a way to do it right to make sure you avoid this. Let's talk about it. What you can do is, if you got, let's say, a long signal on the euro yen, and then you also got a long signal on the euro Aussie, just pick one and ride it. Whichever one you saw first, just go with it. Vaya con Dios. You can't take every trade out there sometimes. So you can just pick one and go with it, or you can also go half and half. Like I said, if you're getting a long signal on the euro yen and the euro Aussie, put 1% on one and put 1% on the other. I'm okay with that. That way, it's a little bit of a hedge almost. If one of them doesn't do you well, maybe the other one will, and it'll save you from a loss, which is important. Or, and I want you to approach this last one with caution. Let's say that the euro yen is giving you a signal now, but that euro Aussie is just like one candle away from giving you a signal, tomorrow. Go half on the euro yen, and that way you can leave the door open if that euro Aussie actually does give you that signal. But I wouldn't do this a lot. I would rather you do this than do that, because in doing this right here, in a way, I've given you a license to go timid. I don't want you going 1% on every trade, just on the thought that there might be something else coming around the corner in that same currency, because then you're going to end up here. You're going to end up like the guy who doesn't make the money they should have made, and your results are going to fall flat. All right, so just be careful to not do that. So in conclusion, let's wrap it all up here. Never fear risk. Take risks. Take lots of risks. That's what being a trader is all about. But just be smart about it, because that's what being a good trader is all about. Be consistent. Take the numbers I've given you and do not deviate from them. All right? Over time, after you've done this and you've gotten experience with it, you can adjust it how you want. If you think there is a better way to do it, I am all for that. But take what I've given you and just get really used to plugging that into your everyday trading. You are going to see some really nice results, I think. As long as your trade entries are good too, getting that money management tight is everything. But just know the calculations. I hope you wrote them down. And find that exit indicator that is going to get you out of a trade sooner than it would if it actually hit your stop loss. I have literally saved thousands of pips just by having my exit indicator in place and not allowing the trade to go all the way that far. So, what is that worth to you? What are your pip values sitting at right now? Multiply that by a few thousand. It really, really adds up. And don't fall into that over-leveraged trap. I've given you a structure, but I've also given you a way to really screw it up if you're not careful. So just make sure you avoid that too. Now, I have given you an entire risk management structure, and we haven't even talked about what to do when your trade is actually winning. That's going to be a whole other video. But what I've already given you is something you can actually use every time you enter a trade with defined levels and numbers. Who else out there is doing that? As important as risk management and money management is, it's everything. Who out there is doing that? Nobody. Just us. Channels and websites out there might throw the 2% number out there and talk a little bit about it, but that's as far as they go. That doesn't really help you. Every single video I make on this channel is, no matter what it's set up to do, whether it tells you to do something or tells you not to do something, is something that you can take away, plug it into your actual trading, and instantaneously start to see better results. So if I'm doing that with one video, imagine what your trading is going to look like 20, 30 videos down the road. As small and as new as we are, there is not a more impactful Forex trading channel out there on YouTube. Does not exist. This is where you want to be. So hit subscribe, give me a thumbs up, and go out there and start looking for those indicators. Put that system together, and now you have a good risk management system already in place to go along with it. Now all you need to do is start using it. Get that experience under your belt. Get used to doing things this way. I think you're really going to like what you see, guys. Let's go get it.